So, good morning to all our viewers. Welcome to investmentguruindia.com. I am Nirav Hemani, welcoming you to this special series with Fund.
Thanks. Thank you for.
So, Mr. Prasad, an important question at the top of the mind of most of our investors and readers is, historically, we have seen during the times of excess global liquidity and benign interest rates regime, commodities like gold and silver tend to outperform other asset classes. Now, a similar story has played out in the last 8 months, and there is a sharp price movement in commodities. Given the central bank's accommodative stance, do you think this rally will continue, and how should investors benefit from this approach?
Yeah, thank you, Nirav. I think this is a very important question to comprehend, and then we should try explaining about this point and how we are looking at the benign interest rates, which has been there by the most central banks globally today. And if I talk about global liquidity, it is infused very excessively, and if you look at it now, global liquidity regime has actually gone much higher. So we'll speak some facts here today before I could answer your point straight away. So let's speak some facts here. Basically, if you look at it from the ever since the COVID started, maybe now it's been 6 to 7 months being in India, and if I talk from the global perspective, it's the COVID-19 means towards the end of 2019, the COVID as a concern came to the world, entire world, and to curtail this, to protect this, a lot of stimulus measures have been taken. In fact, I was reading through a few articles and reports that as many as 285 stimulus measures have been announced around the world for the past 8 months. That is one fact to look at it. And if I talk about broad stimulus, then approximately what is the amount of stimulus being announced? It's tentatively it's around more than $10 trillion US dollars is actually passed or spent over the months and going forward to protect the economic recovery or revival. Besides that, if we look at it, we have been having our quantitative easings by the most central banks before the COVID, and interest rates also have been kept near 0%. So this is one of the points which I said 285 stimulus packages globally announced. More than $10 trillion is the wholesome monies to be spent to bring the economy into recovery stage. And as I said, besides QE and interest rate being at lower, another interesting fact that I want to tell you is that the M2 money supply. I was just looking at some research paper and then I could figure it out that when we talk about money, M2 money supply is nothing but just cash, but along with that, your deposits, money market funds, etc., is all together put together is considered as M2 money supply. If we look at the change of growth of money supply in the US, it is actually risen by 12% in last 10 years. Is the highest money supply inflow. And when we look at the correlation of money supply, which is excessive. So where does this money need to go? Your interest rates are lower. Other financial asset classes are not doing so great. So this money has to be parked somewhere. And then the money has to flow into somewhere, right? So in this case, I could see a good correlation between M2 money supply growth vis-a-vis gold. So basically, whenever the money supply growth rate has gone higher, the gold prices also tend to move higher. And that has happened when the investors have put sufficient amount of investment into gold, both in physical form as well as in e-paper. If we talk about in the year 2018, when we have global financial crisis, 2008, I mean to say, when we had global financial crisis, that time also money supply grew by 2%. But today, with this COVID situation being rising, now I looked at the money supply rate has increased by 12%, which is very, very high. And the replication is now seen on, of course, gold prices, silver prices, and we are seeing prices surging to large extent. The year 2020 has been very, very prominent for bullion market or gold or silver market. I think to answer your question, can the gold, silver prices be continued to remain upbeat in the long run, given the scenario of global liquidity being high or interest rate? My answer is yes. With a lot of stimulus packages being given, the economy needs to grow. We have not yet seen the inflationary concern yet. I think going forward, we will see the rise in goods prices, services prices, and that will increase the inflation. And if it happens, so I think that again there will be again choice only on the gold prices. So I think going forward, the gold and silver prices are expected to remain upbeat in terms of as an investment choice for an investors globally. So we are very upbeat about this sector, and with the accommodated stance by the central banks, with the interest rate being lower and the lot of money supply being infused, are the factors which would continue to keep supporting to the bullion trend in the medium to long term. And that's all I would like to say for this question, Mr. Nirav.
Uh, a quick follow up on the same point that you made. It's okay for new investors probably to jump in and probably take a longer term view in gold and silver, probably. But what about those investors who would have, say, put money in the last 4 or 5 years and now are sitting on some good gains? Should they book profit, or should they stay invested or probably increase their more allocation towards commodities like gold and silver?
I mean, it might be a little subjective to answer should they book profit or not, because every investors will have their different appetite.
Okay.
And if we especially look at last 4 years of return, I'm sure it is handsome enough and it's good enough. So it is one's choice whether they want to book profit or not. But if I would say as an underlying asset, whether they are still looking better going forward next 3, 4, 5 years, I would say yes. Historically, we had never experienced such price rise on gold and silver prices in the world, and we have made a history today, and we have seen the price of gold silver being so high. I think a new normal trend in the sector of bullion is going to happen. So I think it is one's choice whether they want to book it or stay invested. However, one point that I want to make it here is that something that has been excessively gained, it needs to stabilize a bit before it make this trend move stronger. So a consolidation phase could be observed, or maybe some sort of profit booking by the global investors, or maybe by
Okay.
the global fund managers might observe. So that might lead to some sort of short-term price corrections or
Okay.
short-term dip in the asset prices, which is good enough for a healthy direction of a trend. So if it
Right.
happens, so then maybe one can think of partly making their profit booking, and then rest can remain entitled with the trend, and look forward to see next 4 5 years being the best trend for precious metal is concerned globally.
Okay, okay, fair enough. At a fund level, across the industry, there are very few funds which offer to invest in commodities as an asset class. Now, and within that also, gold will take away the lion's share of the commodities investments. Do you think, as an industry, we should have more diversified products which focus on other commodities outside of gold and silver in a more balanced manner, from an investor perspective, to give them a wide range of asset classes within the commodity space?
Yeah, I believe the doors have just started to open now. All these years in mutual fund industry, from the commodity perspective, the only thing that was offered is gold ETF. I
Okay.
think it's time to have more diversified products. I get to hear from the industry that regulatory body is also evaluating to uh, get into more products related to commodities. In fact, some of us in the industry have proposed to regulatory body that we should have silver-based ETF. In fact, I would say that recently Multi Commodity Exchange, which is the largest commodity exchange in India for commodities, have started bullion index trading. Perhaps tomorrow one may look at index futures of commodities being traded. And I'm sure you would know by now that in 2019, SEBI has already allowed commodities derivatives to be part of multi-asset fund and any sort of hybrid funds. Of course, investment limits have been suggested accordingly in the circular. However, I would say it is no more only gold. And typically, whenever gold trend has moved higher, silver has followed the suit. So if one has been investing into gold, then I'm sure it is always advisable to look at silver as well. But since the other avenues have opened, then we should not restrict ourselves to gold and silver. We have today metals, industrial metals. When I say industrial metals, we have aluminum, copper, lead, zinc, nickel. We have energy as a sector like crude oil and natural gas being traded. We
True.
also have several agriculture commodities being traded. I'm sure many retail investors would not have much knowledge about all these commodities besides gold is something that one owns it or knows it. otherwise no major understanding on other commodities other than that we consume it. But I think it's time to look at it. If I broadly talk to you, the gold silver performance has been really good and really great globally, and acceptance is very high. So have we ever looked at the industrial metals performance, or have we ever looked at some of the agriculture commodities performance who have actually given such kind of return, who have actually beaten the returns of gold silver also? So imagine if you have gold, silver, metals, energy, and few agriculture commodities in your portfolio. The commodity itself is making it diversified by choosing ABC commodities, not just depending only one commodity gold. You are creating a diversification within an asset classes that is commodity. And as such, you have equity, which is an asset class within which you have different types of stocks, multi-cap, large cap, small caps. Within that also you have different kinds of instruments to look at it. Then why not in commodities? And why should I restrict myself or oneself uh, to only gold? It's time to diversify to silver and other preferred underlines under the commodities that are being traded. Yes.
So you've been a commodities researcher for quite a long time now, and what has your understanding been? What is the trend, or what is the commodities markets evolution has been over the past 15, 20 years, and how do you see it going forward? You partly answered the question saying that it is now time for the investors to look more aggressively or maybe more intuitively to this asset class. But what has your trend been? Is there any regulatory push that you think should be there? Is the market also opening up? Or do you think more distribution should be trained around this asset class? How has your evolution been?
Yeah. Uh, Beg your pardon, maybe slightly disturbances. Well, actually, on the of course I have been spending on the commodities market throughout my career, maybe 15, 16 years. First of all, I want to tell you one point here is that unlike other financial asset classes here, commodities are never a straight way, or I would say linear trend that it just have to go on rising or appreciating on a yearly basis. They are more of cyclical in nature. I mean, imagine an agriculture commodities, just to make you all understand that every year we face a case of sowing period of agriculture commodities, and then you have harvesting and then consumptions. So typically the trend of agriculture commodities are cyclical in nature. If I talk about gold, in earlier years we used to see that during monsoon season the gold trend diminishes, and during winter and the marriage period or the festival season the gold demand rises. So those patterns are there. They are a bit of cyclical, periodical nature, but unlike other financial asset classes, they are not linear always. So we see when economy grows, the growth rate of economy does well, commodity prices does well. When economy consolidate, we also get to see commodity prices also stabilizes. And also when economy gets into downsize phase, like today we are looking at globally last 6, 7 months, some of the commodities prices also have declined considerably. So the trend is concerned, if I would say, it is in line with the economic growth, in line economic consolidation phase, and of course it is in line with the economic downside also.
True.
Now to answer your question on a different manner, uh, yes, commodities markets in India have been existing in here for last 16 years. One point that I want to make you here is that all these years, this commodities market in India was very much restrictive to retail participants as well as only to few who come to hedge their commodity risk. But now,
True.
with SEBI allowing more avenues for investors, now alternate investment funds have been allowed. Now mutual funds have been allowed, and going forward, I think, like as I said, the index futures also have been allowed. Options also have been now allowed to participate into commodities. So it's time that we should look at banks, FDIs, FPIs to gradually come into the market of commodities and let the commodity market grow on a very robust manner in the long run. So that's what I would look forward to have commodities exposure in the long run in Indian markets.
True, true. Now it brings us to an important question. Having said about commodities, it's the right time to invest. What is that opportunity that you guys have created? You've been managing Tata Multi-Asset Opportunities Fund, and it's a multi-asset category which intends to invest in different asset classes: equity, debt, commodities. Now, take us through this fund. How does a retail investor participate in such strategy? And how is the construct of investing in different asset classes of different points in time?
Surely, I think I would like to discuss that because that's our pioneer product. And I would like to say that we are the first mutual fund in the industry who went forward and got the approval from SEBI to have a multi-asset fund where we have definitely equities and debt, and along with that we have commodities derivatives. So we are the pioneer in the industry having commodities derivative as part of multi-asset. Of course, I would like to share how the product structure is, what is the composition. So first of all, Tata Multi-Asset Opportunity Fund, the NFO was, the fund was launched in the month of February 2020, and we have been experiencing about this fund for the last 5 months now, and I think we are doing great on that. And as far as fund structure is concerned, first of all, this Tata Multi-Asset Opportunity Fund is a equity taxation fund, and as per SEBI mandatory rule, three asset classes minimum have to be invested into the fund. So that is definitely equities, debt, and we have chosen commodities derivatives along with gold. So since it is equity taxation, so 65% of the funds AUM goes into the equity portfolio. 10% we park it into the debt instruments, and remaining 25%, that is 65% equity, 10% debt, and remaining 25% goes into commodities derivatives. I'm sure I will not talk much on the equities within the portfolio, how it has been broken into, but rather I would say that the equity 65% is predominantly focusing on the multi-cap stocks, while valued stocks are the preferred ones by our fund manager of equity. Likewise, from the debt side, if I would say, we have been taking duration funds and very safe trades on the debt portions we have done, and minimum 10% is mandatory required. So we have put those on a very safe instruments from the debt side. Now, coming on to the commodities piece, which I would like to say here, which might sound interesting to everybody also, because no one had experienced this 5 months ago, and we just started it. So when I say within 25% of commodities derivatives, we have not been limiting ourselves to gold. We also have been participating into silver, as I said. We also have been participating into some of the industrial metals. Within the industrial metals also, we are doing very selective analysis and figuring it out which metals looks best among the all. And from the energy sector, we have crude oil and natural gas being traded in Indian markets. So as and when we get some strategies within these two commodities, also we participate. Besides that, we have been also having good amount of exposure on the agriculture trade. So within commodity, if I have to say, I have got bullion as a sector, we have got metals as a sector, we have got energy as a sector, and we have got agriculture commodities as another sector. So within commodities, we have got four sectors, and among the four sectors, what strategy that we should look at it is something that I want to tell you here. When we launched this product and when we got this idea to our distributors, to our investors, to within ourselves, we figured it out that typically it is considered that equity markets are risky in nature. And if one is selecting to participate into a mutual fund where secured 65% goes into equity, that asset class is considered considered risky. And to mitigate that, some sort of riskiness into that, you have a flavor of debt of 10%. So now this 25% of commodities, we don't want to bring much of riskiness to the fund. Rather, let us bring something to the commodities from the commodities, which will be slightly accommodative to the entire fund. Plus, it does not create a lot of volatility, and overall 65% equity exposure, 10% debt, and 25% commodity exposure should, on a holistic manner, bring a stability to the fund. So therefore, we have chosen that within commodities, we'll try to do a lot of arbitrage trade, lot of calendar spreads trade, and we'll have very limited directional trade. So that the riskiness of the commodities being limited to very limited extent, where we do arbitrage trade, so we don't see major risk on doing commodities arbitrage trade within the periphery of SEBI guidelines, within the periphery of exchange guidelines, and whatever is statutory measures are to be needed, insurance and all everything is being taken care, and we do commodity arbitrage trade as a major strategy. Second strategy that we do, as I told you, is the calendar spreads, because typically they are not vulnerable to the price volatility, but spreads are typically less volatile than the directional trade of commodity. commodity. However, the third strategy that I would say, that we do sometimes take directional trades on some of these select commodities, but what I want to make it point of very clear is that the percentage of directional trade on any commodity is always lower than the kind of exposure that we take on arbitrage trade or spread strategy. I hope I tried explaining the multi-asset fund of ours and its trading strategies. Just to
Right.
recap, we have equity, debt, and commodities. Equity, debt, we have just spoken on a brief. Debt, 25% is allocated into, divided into arbitrage, spreads, and directional trades. Yeah, Niro.
Interesting point you made that. And viewers, just to help you understand arbitrage point, Mr. Prasad, if you can just help explain, because there will be novice investors, if you can just explain what is an arbitrage and how does it work in a commodities marketplace.
Yeah, sure. I think, I mean, that's a very question that one should understand, and good that you asked. If I, on a nomenclature point of view, if I try to explain how does equity arbitrage takes place, is that equity fund manager buy a cash equity and simultaneously he sells a same equity stock futures. And if he or she observes that there is an arbitrage opportunity in the equity cash to futures, with all the conditions met, then he executes or she executes the trade. Now, that's a very plain vanilla rule of equity arbitrage. When we talk about commodity arbitrage, the rule remains same. But let me make it very clear is that commodity, there is nothing called cash market being traded here in the commodity exchanges. So all that is being traded is commodity futures and commodities options. Just to reiterate again, the commodity futures contracts are deliverable in nature. Meaning, if we are investing into gold futures contract, at the time of its expiry, the gold futures contract can be converted into gold physical delivery. So to execute commodity arbitrage trade, one has to, a fund manager has to, at the beginning, have to create a long future positions and simultaneously sell another future positions of the same underlying with two different contract periods. Taking an example here, let's see if I buy gold January futures contract and sell gold February futures contract. Of course, if there is a price difference, after inculcating the cost into the factor, if a fund manager sees that there is an opportunity, then only he gets into such trade. So now one is buying future contract and selling another future contract of same underlying with different contract month expiry. So on, as this example I cited here, as the January month comes into expiry, the January future contract converted into physical delivery of contract, which exchange takes the guarantee of giving and taking delivery, being the mediator between a buyer and seller. So once the commodity is being delivered in our hand, of course, when I say in hand means there are exchange accredited warehouse where stock is being kept, and against that you get a dematted stock certificate from the exchange. So in one hand today, you have physical commodity lying in the warehouse where you have the insurance being taken care and all facilitation, quality testing, quantity testing, everything being taken care. And in another side, you have a short future in the subsequent future contract. So when the next future contract come into its expiry period, as per SEBI mandate, we need to give delivery back of the stocks to the exchange or outside in the next expiry period. We can, since we are running a short positions, we just have to give short positions delivery and square of the trade. So typically the commodity arbitrage trade in India are of 30 days, 31 days of trades because the contracts are monthly in nature, except few like gold and silver who are bi-monthly contracts like 60 days and 90 days kind of contracts. I hope I try to give a little clarity on how does commodity arbitrage takes place. I'm sure if some have doubt, I'm sure one should write to Mr. Nirav or to us
Sure.
directly. But I tried explaining how does the commodity arbitrage
Right.
take place.
Yeah. Very, very important point you made, because not all probably would understand. Maybe they won't understand equity arbitrage, but commodities arbitrage is a different concept altogether. And to understand this and then to invest in a fund like multi-asset opportunities fund will give them a better opportunity. Now, coming to a rebalancing strategy. Now, there will be points in time where equity will perform, or maybe commodities will perform, or debt will perform. You will have your asset allocation maybe skewed little higher towards a particular asset class. What will be your rebalancing strategy? How do you take care of it? Is there any model that you have particularly in mind, or you have a framework that you follow, or how is it?
Yeah, I think I want to make a point very clear is that whenever we decide upon a multi-asset scheme, first clarity needs to bring in is that here is that it's going to be equity taxation scheme or a debt taxation scheme. The moment we have selected our Tata multi-asset fund that it is an equity taxation scheme, we have no choice than keeping the equity exposure at 65%. So at any point in time, we cannot bring down our equity exposure below 65%. And this 65% of equities could be between equities and equity related strategies.
Right.
So my 65% on this scheme remains intact with equity portion. That is one rule where we cannot bring any changes, even if we wish to. Second, three asset classes have to be must be there in the scheme. Like I said earlier, we have equities, we have debt and commodities. And the rule of multi-asset is that minimum 10% asset allocation has to be there. So that typically means we cannot even change any structural changes to the debt exposure of 10%. So what is left for us is that 25%. This 25% we might reduce tomorrow to, let's say, example, 15%, and increase the equity exposure from 65% to 75%, or 25% bring it down to 15% and increase the exposure from 10% to 20% of the debt structure. That is the only changes that we can bring in. Just to summarize, 65% of equity can go to 75% and reduce your commodity exposure from 25 to 15, or increase the debt exposure from 10 to 25%, or reduce the commodity exposure from 25 to 15. The only tweaking that can be made is between these within the 25% of commodities, which can be brought down to minimum 10%. So these are the few changes can be brought. Otherwise, within the asset classes, of course, I cannot answer much, but with the equity 65%, what our fund manager will look at it, how he's going to allocate between different stocks, whether it is going to be pharma stocks, going to be consumption stocks, is going to be IT stocks. That I think they themselves take it based on their investment decisions. But collectively we work on together. But within 65%, I cannot make much of comment here. But 25% of allocation, how do I manage my 25% of commodities exposure is something that we look at it from the commodity investment point of view. And we try to manage between whether it should be gold, silver, it should be metals, it should be energy, or it should be agri, or mixture of everything.
So here you have Tata Multi-Asset Opportunities Fund, which is multi-asset at all points of time. So it is by mandate of SEBI that it will invest a minimum of 65% in equity to enjoy equity taxation. It will invest 10% minimum in debt because it has to invest in three asset classes. And the third portion is the commodities piece, which is 25%. The rebalancing can be done by decreasing the commodities portion, increasing the debt of the equity portion. So in a sense, you get a multi-asset fund at all points of time. Mr. Prasad, coming to a retail investor who is probably just starting out, or he's not understanding, or maybe he does not understood the asset allocation model. Is this fund the right opportunity for him to invest, and how should he invest in such a strategy going forward?
So, I mean, I can try explaining one point here. I mean, typically, people invest into balanced funds where you have maybe 50-60% of equity, 40% debt, and people also invest into pure equity funds where large portion is spent on the equity, invested into the equity. So again, it is a risky assets. Multi-asset is concerned, we have tried explaining how does the multi-asset functions. The retail investors may have had good experience on the equity market exposure and equity participation. They would have also experienced the debt as a product or instruments or another asset class. Now, commodities are opening up. All these years, we have been looking at only gold. My submission will be here is that one need not only depend on gold. You have other assets within the commodities as a head assets, other underlines. So if gold is doing well, we have also noticed that silver also at times outperformed gold. If one has silver along with gold, then I think his or her performance is better than being having only gold. And there are times when gold and silver gets into a very submissive phase and doesn't move at all, and they get into a consolidation phase. And that particular moment, it is possible that energy sectors are doing great, or maybe agriculture sectors of some of the commodities are doing really great. We have been unaware about all this. So having a taste of all these commodities flavor into a portfolio, and also tasting a new asset class, which is commodities. And retail investors may not have much of knowledge about commodities, but unless you participate, experience, and understand, by end of the year, one either make some percentage of return on the fund plus a lot of learnings on the new asset class that is commodities. I'm sure by any individual investor or a corporate investor who's investing into such funds, and end of the returns, they also get to learn a lot of understanding on the new asset class. So my urge would be that we have been looking at equities, we have been looking at debt. Let us have a composition added to it that is commodities, and which is not restricted only to gold. Let us experience more commodities beyond gold. So I think retail investors today have a new options to look at it, new choice to make, and one should give it a trial and understand how it is safe and how it is adding value to the one's own portfolio. Yeah.
So a couple of questions before we wrap on the show. In the times of uncertainty, Mr. Prasad, we have seen that there is a flight of safety, flight to safety among investors. Now, with respect to currency, US dollar presents itself as a safe haven. How should an investor probably benefit of this shift to safety, which possibly leads to rupee depreciating against the dollar? If you have any views around the currency piece.
When people run towards the safetyness of asset classes, one thing I'm sure by now would have understood that when a risky situation, gold tends to do well, and gold is also considered as one of the safest haven asset class. Gold does well, and silver follows the suit. However, when rupee starts depreciating against the dollar, as you rightly questioned me, some of the commodity prices in India also become expensive. Let me put an example here. Yesterday, we saw rupee appreciating very strongly against the dollar. I'm sure I'm talking about 24th August yesterday, where rupee appreciated very strongly. And some of the commodity prices also declined considerably because rupee got stronger. So now that was not a right example to cite here. Now imagine if rupee is depreciating from some number to another number, let's say 5% or 10%. I'm sure the commodity prices will also follow the run up because most of the commodities that we consume in India, except a few, are all import dependent. Talk about oil, talk about gold, talk about silver, talk about some of the industrial metals. They're all import dependent commodities. So when our currency depreciates against the dollar, this commodity price tends to move higher. So if one has a view of depreciating view on currency in the country, then buying commodity derivatives actually adds value to your return. Imagine if you're buying crude oil and imagine you're buying crude oil and your rupee depreciates by 10%, you get the effect of 10% when you're investing into crude oil. May not be exactly 10%, but there is an effect of rupee depreciation into commodities derivatives investing. So I think if currency appreciates or depreciates, it has a concurrent impact on the commodities price trend, and accordingly, it also impacts your portfolio.
Okay, great. Interesting example that you cited, that when rupee depreciates, the asset prices on the commodity side can appreciate and go up, and vice versa is also true. So probably something you can watch out to. And I'm sure that all of that is figured well in the multi-asset strategy which Tata Mutual Fund has presented. One final question before we wrap on this show. According to many research studies, India's 90 to 95% of household savings are locked in physical assets like physical gold or real estate, And over the last 5 to 7 years, SEBI and the mutual fund industry and the distributors have done exceedingly well to incorporate a lot of investors into the mutual fund industry space. We are still probably scratching the surface as far as the mutual fund AUM is concerned. But what do you think? How can we accelerate the financial assets through this kind of strategies? Because this is a unique product, something which Tata Mutual Fund has pioneered. And do you think, part two of the question is, do you think such innovation should continuously happen from the regulator and from the industry to help investors get a more diversified view? So what is your view to get more and more investors onto the mutual fund space?
I think the action has started. People have been participating into physical gold, as you rightly said, or real estates. The trend is slowly changing, and it's being started with this generation. I think people are now understanding investing through e-papers or investing through ETFs and mutual funds. And we have been seeing a lot of traction all these last 5, 6 years. And I would always be thankful to the regulator SEBI that ever since they have been managing commodities per se, I would say a lot of changes has brought in and a lot of new asset class, a lot of new initiatives being taken. Now we have alternate investment fund in the industry, which was never there for commodities. It's been 3 years now. We have now commodities mutual funds, as I said. Of course, since it is a baby step move by the SEBI, the regulatory norms restricts to a certain percentage of participation into the commodities. I would urge here is that SEBI relaxes more norms for commodities, and options have been participated. We are looking forward to have banks being allowed to participate into commodities, FPIs being allowed on commodities. If such doors are open, which is likely to happen going forward. In fact, as I mentioned earlier, that index futures have just started. I think tomorrow one may think of having index futures based ETFs in the commodity space. So things are already progressing, and I would look at that dependence on gold is not to be limited. One can diversify within commodities, get into other products. Electronic version of investing into commodities or any other class is more preferred than having physical storage. I'm sure holding physical storage has its own challenges. It's better to have dematerialized one's asset, and when we have such provisions, then why not looking at it rather just investing into physical assets? And you cannot ever replace your buying a property to any virtual space, I'm sure, but other investments can be looked at into other forms of dematerialized form.
Great.
Yeah.
Yes, thank you. Thank you so much, Mr. Prasad. It was enriching and enlightening to talk about a pioneer strategy which Tata Mutual Fund has brought about. So viewers, there you have it. Check out on Tata Mutual Fund website for Tata Multi-Asset Opportunities Fund. It's a, just to wrap up, it's a multi-asset fund. So essentially, if you, cannot figure out what strategy you need to have in terms of the asset allocation, just go out there and probably start your SIP or put lump sum amount to understand how derivatives market in commodity space work, how debt works, and how equity works within that particular fund. With that, that's a wrap on this show. Thank you, Mr. Prasad, for joining in. It was a wonderful. And just a quick disclaimer, mutual fund investments are subject to market risk, and read all the scheme related documents carefully before investing. And one quick disclaimer again, mutual fund, past performances may or may not repeat in the future. So take, very good advice from your financial advisor before trying to invest in a particular fund. With that, thank you so much, Mr. Prasad, for joining in. I look forward to many much more sessions on different topics, probably at a time soon. Thank you so much, and have a great day. Thank you.
Thank you, Nirav. Thanks.